Now, in this piece, this is Market Watch. I'm going to be talking about all things interest rates and moving on to mortgage rates and what are the implications. So first of all, let's start with the really, really good news. Finally, on the 1st of August, we had the Bank of England to come off the fence and drop rates from 5.25% to 5%. So the question is that the trickle before the flood? Are we going to see multiple interest rate drops? Well, to answer that question, we've got to look under the surface. We've got to go back to that meeting on the 1st of August because there are 9 committee members. And this is how much on a knife edge it was. 5 of the 9 said, yes, let's drop rates down by 0.25%. 4 of the 9 said, no, it's a little too early. They wanted to be a bit more prudent. That's how close a call it was. Now, you might be saying, because I talk about inflation so much every month, it's so important to this conversation. And the Bank of England's main objective was to get inflation down to 2%. And they use interest rates, moving them up or down, as a blunt instrument to achieve that 2% target. Now, you and I now know that inflation target has been hit. That 2% has been hit in May, again in June. Okay, it's gone up slightly in July, but that was anticipated. It was expected. It is not a shock. It's not heading back north again. It is a little blip. So we're not concerned about July. So essentially, the Bank of England have done the job. So it's a done deal. Come on, Bank of England. We should be now dropping rates even more. And actually, when I now turn to the banks and building societies and other lenders, they are thinking that at the next meeting, 19th of September, make a note in your diary, that the Bank of England are likely to drop rates again. I think that because they're starting to drop their mortgage rates a little bit more. They did start in July in anticipation of that 1st of August drop, which is brilliant news. We all welcome that with open arms, but rates are dropping again. Now, there could be another thing going on here. Yes, it might be that there's an expectation that rates are going to drop a further 0.25% on 19th of September. But in addition to that, we've also got that the impact of that 0.25% drop back on the 1st of August, whereby we saw with Rightmove and Zoopla, these are the 2 big boys out there, all their data was saying that activity, transactions are up by 25%. And that, of course, is going to feed through not only to viewings, offers in on properties and sold signs going up, but ultimately into mortgages. So the lenders want to position themselves to get a bigger slice of a growing pie. Now, so let's get back to the concerns, however. So yes, we've hit this inflation figure of 2% month on month. But here's the concern for those 4 committee members I mentioned a little earlier, because you've got to get under the surface of this inflationary figure. Because when you do that, there's inflation for various sectors within the UK economy. And some of those sectors are really, really dragging their heels. And that's why there's a concern by the Bank of England. And one of those in particular is pay inflation. And of course, we've got this new Labour government coming. And what have they done? Within weeks, agreed significantly higher pay awards to various public sector bodies than the Tories were prepared to do. And that's likely to have its ripple effect. Now, a really, really good example of the nervousness of the Bank of England, because the impact is you then have, as an employee, you have more money in your pocket than you otherwise have thought. You've got more disposable income. Therefore, you spend it more readily. That creates a surge in demand. And therefore, the suppliers of various products and goods and services, what do? They put prices up higher than they need to do. And that is how inflation starts to creep back up. And that's why the Bank of England are really nervous about the pay inflation figures. And the example that we've all been seeing, maybe we don't realize in this context, but the Gallagher brothers, our friends Noel and Liam, we know, don't we? Anyone on the planet, you've got to be living under a rock to not know that they're reforming as Oasis. And so everyone that wants to get a ticket have been joining that long queue on Ticketmaster or wherever. The face value price is 150 quid. You get to the front of the queue, and what's happened? It's not 150 quid, is it? No. It's 450 quid because the guys pulling the strings at Ticketmaster can see the level of demand and think, do you know what? We think we can get away with higher prices. So Noel and Liam, come on, boys, do the right thing. You're not short of a few quid. Let's get back to face value pricing, because if that was replicated across the UK economy, then we would, I can assure you, start to see inflation creeping back up. And guess what? That means that interest rates are going to get stalled and will not come down at the pace. So really interesting scenario there with our Oasis friends, and how that has a real life potential impact if that was widened across the economy, and then the impact on inflation. So in addition to that, lenders are starting to drop rates again, which is really good news. I'm now seeing, I think there was I looked yesterday, about 5 or 6 different buy-to-let lenders on offering 5-year deals under 4% now. So when I did my last update, I don't think we had any lenders offering deals starting with a 3. And now we've got about 6 lenders. So that is the direction of travel, that rates, of course, are getting cheaper. And I do expect that to continue. But I want to also talk about average interest rates, because that is useful in a certain context. So the typical average 5-year fix right now is 5.34%. And that's if you are getting a buy-to-let in personal names. Now, if you have a buy-to-let in a limited company, that's higher. That's 5.85. So we've got about a 0.5% differential. Now, why is that interesting? Because if we go back only 1 year, and actually let's go back to 2016, right up to 2023, the differential has been at least 1%. And all of a sudden, we're now seeing that gap narrow and narrow and narrow. So if you're a limited company landlord where you've got mortgages in your SPV, then that's really, really good news. And why is that? Because I've said on a number of occasions on these updates, when we talked about limited company mortgages, that I do think that these lenders are profiteering. Yes, they've got to do a little bit more due diligence on a limited company application, but does it justify an extra 1% or more on the mortgage rate? I've always said that was not the case. And finally, the rates are starting to get closer to those personal rates, which is really good news. And one of the reasons I think that is that we're getting more competition in. Go back 2 years, and there were no high street lenders, no banks, no building societies would offer limited company mortgages. And now Leeds Building Society joined the party. Leek did, Family Building Society, Mansfield, Nottingham Building Society, and only in the last week or so, Metro Bank have also come in, and they're now offering limited company mortgages. So expect to see more lenders joining this market. It's going to get wider, creates more competition, and I think that differential is going to drop even further. So that's really, really good news. My forecast is that mortgage rates will continue to drop the rest of the year. We're going to see at least 1 drop from the Bank of England, if not 2, by December, and that you'll see that saving passed on through mortgage rates. However, the question is, do we sit on our hands? If we're coming off the end of a deal right now, do we wait until the rates have dropped even more come Christmas, or do we jump now? And that's a question we're asked quite a lot back at the Mortgage Home. Look, I've got to give you a generic answer. Obviously, each answer is specific to your circumstances. However, my gut feeling is get those savings now, because if you're waiting another 3 months for rates to drop, and then you put in an application, it could be another 2 months before you're onto that new rate. So you could be talking 4, 5, 6 months before you actually see those savings. In the meantime, if you're on SVR, then you're losing money to save money down the line. So it could be a false economy. So my gut feeling is certainly speak to you, engage with your broker, get those new rates right now, and start the application process and get them saved. If rates do drop while the application's in, your broker should be able to access those even lower rates before you've actually completed, so that you don't miss out. So I hope that's been of use to you. And like I say, if you do want to have a review, there will be under this video a link to our online diary. Just book some time in, have a chat, and let's see if we can help.